The current exchange rate is 1,438.51 per dollar. On the 24th, it was over 1,481, but now it's in the high 1,440s. Some banks ran out of $100 bills, while the National Pension Service chose to sell overseas assets more often based on exchange rates. Let's examine this topic today. The exchange rate's quick climb toward 1,501 has suddenly stopped, hasn't it? On the 24th, the exchange rate dropped 33.81 to 1,449.81, the lowest since November 6th, about a month and a half ago. This is the biggest drop in over 3 years, since November 11th, 2022, when it fell by 59.11. Foreign exchange authorities recently announced several exchange rate measures, releasing most on the 24th. Kim Yong-byum, chief policy officer of the presidential office, told the media they will act instead of talk, and that things change starting today. The Ministry of Economy and Finance and the Bank of Korea quickly stated after the Seoul foreign exchange market opened on the 24th that excessive weakness of the Korean won is undesirable. The foreign exchange authorities gave an unusually strong warning. The government also claims the government blamed Seohak Ants, Korean individual investors abroad, for the recent exchange rate rise. They proposed exempting the 20% capital gains tax on overseas stocks for a year if investors sell them and invest in Korean stocks for a year. To quickly lower the exchange rate, foreign exchange authorities have introduced 11 measures. With the high exchange rate raising prices and public concern, authorities are taking strong action. The recent sharp drop in the rate is believed to be due to the National Pension Service's strategic currency hedging. Many foreign news outlets report the National Pension Service started strategic currency hedging on the 24th. The government promptly formed a task force from the Ministry of Health and Welfare and the National Pension Fund Management Headquarters to clarify the hedging. This allows flexible strategic currency hedging based on market conditions without needing Fund Management Committee approval each time. They manage currency hedging by often selling overseas assets based on exchange rates, effectively using the National Pension Service to stabilize the exchange rate. In this situation, there was also a warning from the International Monetary Fund. The International Monetary Fund found that over the next 5 years, Korea's government debt to gross domestic product ratio will rise faster than any other non-key currency country. As the population ages and the government adopts expansionary fiscal policy, mandatory spending and overall expenditures are expected to rise quickly. Korea's government debt ratio is 53.4%. However, the International Monetary Fund projects it will rise by 10.9 points to 64.3% by 2030. This is the highest increase among countries except major currency nations like the United States. Government debt is rising quickly because gross domestic product growth can't match the rate of debt increase. The Ministry of Economy and Finance projects annual national debt growth rates of 8.7% in 2026, 8.3% in 2027, 8.6% in 2028, and 7.5% in 2029 under expansionary fiscal policies. But with nominal gross domestic product growth at 3.4% yearly, the deficit ratio keeps rising, right? When debt rises, the government must allocate more budget to repay principal and interest. This can increase government bond issuance and raise interest rates. Rising debt can impact exchange rates and prices over time. To ease debt repayment, the government may boost the money supply, which can raise prices and lower the one's value. This is why economic authorities are concerned. Anyway, in the midst of efforts to stabilize the exchange rate in the foreign exchange market, there was a situation at a branch of a commercial bank where $100 bills ran out. This happened because many people wanted to buy dollars as the exchange rate dropped sharply. Hana Bank said the temporary shortage was due to headquarters missing the timing to request dollar bills, not a dollar shortage. The market has somewhat resolved the immediate issue. Unless the fundamental structure changes, high exchange rates will likely persist. As has been repeatedly emphasized before, the dominant analysis is that the main reasons driving up the current exchange rate are not overseas stock investments, but rather the interest rate gap between Korea and the United States and the increase in money supply, that is, the expansion of M2. To address this, we must examine the money supply before interest rates. Experts note the Korean won has been issued more than in other countries, with a 22.2% increase in money supply over the past 3 years and 9 months. This means the government has kept supplying liquidity by increasing fiscal spending. Even after the COVID-19 pandemic, by not shifting to tightening and maintaining an expansionary fiscal policy, an environment was naturally created where the value of the Korean won had no choice but to weaken. How clear this trend is becomes even more evident when compared to the United States. During the same period, the increase in the money supply in the United States is being controlled as the United States has shifted to a tightening policy and is managing liquidity, but Korea is relatively continuing to inject money, so a structure has formed where the value of the Korean won is falling more rapidly. Dumayong's money supply was 3,639 trillion won in January 2022, rising to over 4,447 trillion won in Korea by September 2025, a significant increase. In the United States, the money supply rose slightly from about 3,150 trillion to 3,260 trillion dollars. Additionally, Korea's base interest rate is 2.5, while the United States is at 3.75, creating a 1.25 point gap. The longer this situation continues, funds will naturally move to the dollar. That's because the interest income you can earn by holding dollars is greater than holding won. Meanwhile, rising demand for safe assets is boosting the dollar and keeping the exchange rate under pressure. In the past, when the United States raised interest rates, Korea also moved in a similar direction to manage the gap. However, this time, that trend did not appear, and as a result, the interest rate reversal has become fixed. This interest rate reversal has lasted longer than any previous time in Korea's economic history. There have been cases in the past where the Korea-United States interest rates were reversed, but including 1999, 2005, and 2018, there have only been 4 instances so far. At that time, it usually returned to normal within about 2 years, or at most between 21 and 25 months. However, this time, the situation is completely different. Since 2022, the interest rate inversion has continued for 42 months, and not only is the period longer, but the burden felt by the market is also much greater. The inversion is significant at 1.25 points, mainly due to the recent 0.75 United States interest rate cut. Without it, the inversion would be even greater. As this prolonged and significant interest rate inversion continues, the burden on the overall Korean economy is accumulating, and this is serving as an important factor behind the upward trend in the exchange rate. Many experts expect the exchange rate to stay in the low to mid 1,401 range by January, a notable decrease. Export payments for year-end shipments usually occur in January and February. Korean companies' overseas branches also often remit money to their headquarters. That's why the exchange rate often drops early in the year. Due to this and government plans, the exchange rate is expected to stay in the low to mid 1,401 range until January. But the reason the exchange rate is so high is because of structural problems, so unless those structural issues are resolved, there's a high possibility that the exchange rate will continue to rise. In the end, what's more concerning is that there are hardly any policy options left in the current situation. Let's first look at the option of raising interest rates. In theory, raising the base interest rate can reduce the interest rate gap between Korea and the United States and ease the upward pressure on the exchange rate. The problem is that the cost is too high, as household debt is already too large. If interest rates rise further, consumption will be affected first. As the burden of mortgage loans, jaunt loans, and credit loan interest increases at the same time, households have no choice but to reduce spending, which leads to a contraction in domestic demand. When domestic demand cools, self-employed people and small businesses are the first to be affected, and employment and investment also shrink. The concern about an economic recession becomes a reality. The central bank is in a situation where it has to choose to cool down the overall economy by raising interest rates to control the exchange rate. But will not raising interest rates solve the problem? Not necessarily. Freezing or lowering them may increase exchange rate instability. With the interest rate gap with the United States already over 1 point, if it lasts, funds will keep moving to the dollar. Foreign capital faces rising outflow pressure, risking a persistent weak Korean won. When the exchange rate rises, import prices go up, and the burden of energy and raw material costs increases, which stimulates overall inflation. If prices become unstable, real income decreases, which in turn leads to reduced consumption. Choosing not to raise interest rates also puts pressure on the economy. On top of this, fiscal policy comes into play. Tightening fiscal policy can slow the growth of the money supply and help ease situations where too much won is circulating in the market. In the mid to long term, this can also help stabilize the exchange rate. Reducing fiscal spending requires cutting expenditures, affecting welfare, pensions, and support policies. This is the toughest political choice. The government has already announced expansionary fiscal policies, so if they suddenly decide to cut spending now, there will inevitably be strong backlash. Local elections are coming up next year, especially significant in the pre-election political climate. In the end, tightening fiscal policy is economically necessary, but it's very difficult to implement in reality, so raising interest rates is a problem. Not raising them is also a problem, and cutting spending is not easy either. All these challenges are happening at the same time. All 3 options come with clear side effects, so it's difficult to boldly choose any one of them. Share your thoughts on the current exchange rate in the comments. That's all for this video. Thank you.